save your cash, and still find yourself falling behind. Your money is slowly, constantly disappearing without any warning or obvious mistake. We notice the strain when a cup of coffee or a carton of eggs costs more. However, businesses raising prices is a symptom, not the root cause. The actual disease is the structural devaluation of the currency itself. Each dollar in your pocket buys less today than it did yesterday. In the aftermath of World War I, the German mark collapsed so severely that children played with stacks of paper currency as building blocks. When governments print money without backing it with physical assets, the paper it's printed on eventually returns to its intrinsic value, almost nothing. Focusing on the dollar amount on your paycheck is a financial illusion. If your income goes up, but those new dollars buy fewer groceries, pay for less gas, and cover less rent, you aren't actually wealthier. True wealth is measured entirely by purchasing power. Consumer goods corporations know we obsess over superficial numbers. To keep the shelf price exactly the same, they quietly reduce the physical size of the product, a tactic known as shrinkflation. Shoppers notice the price hike and walk away. Most people never weigh the box. They grab the familiar package at the familiar price. This chart shows the exact math behind the strategy. If a mainstream consumer brand raises its price by 5%, they typically lose about 6% of their total sales. But if they shrink the package volume by 5% instead, sales only drop by 3%. By giving you 5% less product for that same price, the company lowers its production costs and pockets the difference. Shrinkflation works perfectly because the modern consumer economy trains us to track labels and price tags rather than calculating actual physical value. When you finally negotiate that 5% raise at work, it feels like a victory. But if inflation is also running at 5%, your purchasing power hasn't moved an inch. This tax bracket scale illustrates a trap called bracket creep. Your nominal wage increase pushes your new earnings over the threshold into a higher bracket. While your marginal rate stays the same, your average tax rate goes up. Ultimately, your net real income drops. Earning a standard cost of living raise during a period of high inflation guarantees you will be taxed more aggressively. It operates as a hidden government tax hike, disguised as a promotion. This illusion extends directly to the assets you already own. If you check your home's online estimate and see the value has skyrocketed, you feel financially secure. But a higher property valuation triggers aggressive spikes in your property taxes and insurance. Recently, these ownership costs have risen twice as fast. Add in lifestyle inflation, where you upgrade your car or apartment with every pay bump, along with compounding monthly subscription fees and high-interest credit card debt, your disposable cash flow vanishes. When an illiquid asset creates digital wealth but aggressively consumes your actual monthly cash flow, you become house-rich and cash-poor. Without liquidity, you are trapped. To understand why these traps exist, we have to look at the engine driving them, the rapid expansion of the M2 money supply. Central banks hold the levers of monetary policy, printing dollars to inject massive amounts of liquidity into the financial system. When you combine this massive increase in paper currency with bottlenecks in physical supply chains, the math becomes unavoidable. You have far more dollars chasing a limited supply of actual goods. Once fiat currencies were decoupled from the gold standard, governments discovered they could use controlled inflation as a tool. By slowly devaluing the currency, they quietly deflate their own massive national debts, transferring the cost directly to the purchasing power of their citizens. Because central banks are incentivized to maintain this steady inflation, the cash sitting in your wallet is structurally guaranteed to lose its value over time. Keeping all your savings in a traditional bank account is an active decision to lose money. Over a decade, fiat currency will mathematically fail to preserve your purchasing power. People who build lasting net worth operate under a different set of rules. They rapidly move their capital out of fiat currency and convert it into real estate, equities, and ownership in hard businesses. These specific asset classes work because they are inherently scarce. They naturally absorb inflationary price increases, allowing their underlying value to grow faster than the dollar degrades. Financial security depends on the strategic accumulation of assets that gain value as currency degrades. To execute this strategy, you have to block the leaks in your own cash flow. The next time you get a raise, implement a strict 30-day waiting period before you upgrade your car or sign up for a new subscription. Then, set up automatic transfers so your new income moves instantly into investments. Take any remaining cash and ruthlessly pay off high-interest consumer debt, which will always compound faster than your portfolio can grow. While central banks drive inflation from the background, the protection of your personal net worth remains a matter of individual strategy. Inflation will continue to rise. The survival of your wealth depends on a portfolio designed to outpace it.